Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about OCUMENSION Therapeutics' annual report. OCUMENSION Therapeutics is a leading ophthalmic pharmaceutical platform company in China that provides a wide range of treatments for various eye conditions. Its portfolio includes therapies for chronic non-infectious uveitis, conjunctivitis, diabetic macular edema, dry eye, glaucoma and ocular hypertension, postoperative inflammation, choroidal neovascularization, bacterial conjunctivitis, retinitis pigmentosa, age-related macular degeneration, cornea graft rejection, myopia, and optic neuritis. The company's services include the discovery, development, and commercialization of ophthalmic drugs. Its extensive portfolio covers a broad spectrum of eye diseases, making it a one-stop shop for patients seeking treatment in China. With its expertise and resources, OCUMENSION Therapeutics is committed to improving the lives of millions of people suffering from various eye conditions. Some of the key businesses and services provided by OCUMENSION Therapeutics include treatment of chronic non-infectious uveitis therapy for infective and allergic conjunctivitis, diabetic macular edema treatment, dry eye management, glaucoma and ocular hypertension treatment, postoperative inflammation management, choroidal neovascularization therapy, bacterial conjunctivitis treatment, retinitis pigmentosa management, age-related macular degeneration treatment, cornea graft rejection prevention, myopia treatment, optic neuritis management. Overall, OCUMENSION Therapeutics is a prominent player in the Chinese ophthalmic pharmaceutical market, offering a comprehensive range of treatments for various eye conditions. OCUMENSION Therapeutics' market capitalization of $6 billion is materially smaller than most of its industry peers of roughly $21 billion. OCUMENSION Therapeutics trades at a lower price-to-book ratio of 1.41 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 5% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by the accelerated ramp-up of core products, such as OT-502, Biojing OT-702, and Yaoxiing OT-401. The company's international strategic collaborations have also contributed to its revenue growth. Additionally, the growing demand for diagnosis and treatment in areas such as dry eye disease, glaucoma, diabetic retinopathy, and myopia control has driven sales of ophthalmic products. The robust growth of China's ophthalmic pharmaceutical market, driven by population aging, electronic devices, and health awareness, has also contributed to the company's revenue growth. Furthermore, the successful integration of 8 dry eye and surgical eye drop products with Alkin and the launch of core products have boosted sales. On the other hand, revenue decline is primarily driven by a decrease in sales-based royalty, income from customers completing their sales, and an increase in selling and marketing expenses. The partial achievement of performance targets resulting in proportionate vesting has also contributed to the revenue decline. Overall, the company's revenue growth or decline is heavily influenced by its ability to commercialize new products, expand its ophthalmic formulation CDMO business, and navigate changes in market demand and regulations. Net income has turned positive for the first time since inception, marking a significant milestone in the company's financial performance. This change is attributed to various factors, including the completion of capacity upgrades and the full rollout of OCUMENSION manufacturing. The latter has enabled substantial cost savings through economies of scale. Profit margins are also expected to improve due to cost structure optimization and robust growth momentum. Specifically, gross profit margin is anticipated to increase as a result of reduced product costs and improved efficiency. This is evident from the 60.4% increase in gross profit, which rose from RMB 125.1 million to RMB 360.9 million. The company's revenue has also seen a significant surge, increasing by 93%. This growth can be attributed to various factors, including the localization of Yaoshiying products, which is expected to reduce overall costs. Overall, these changes indicate a positive trend in the company's financial performance, driven by strategic initiatives and operational improvements. The company's financial performance indicates a significant milestone in its journey towards stability and growth. One of the most crucial indicators of this progress is the generation of positive operating cash flow. This achievement signifies that the company is able to cover its operational expenses from its current revenues without relying on external financing or debt. This development has several implications for the company's future prospects. Firstly, it demonstrates a high level of financial discipline and management efficiency. The ability to generate positive cash flow allows the company to invest in growth initiatives, pay off debts, and reward shareholders, thereby enhancing its overall value proposition. Furthermore, the generation of positive operating cash flow is a key indicator of a company's long-term sustainability. It suggests that the business model is robust enough to withstand market fluctuations and economic downturns, making it more resilient to external shocks. This, in turn, provides investors with confidence in the company's ability to deliver consistent returns over time. In conclusion, the generation of positive operating cash flow by the company is a significant achievement that bodes well for its future prospects. It reflects the company's commitment to financial prudence and its ability to navigate the complexities of the business landscape with ease. The company's debt level has undergone a significant transformation over the past year. According to financial reports, the total debt level increased from RMB 16.5 million in 2024 to a staggering RMB 158.2 million in 2025, marking a substantial rise of 863%. This increase is further emphasized by another report stating that the total debt has grown from RMB 16,547 million to RMB 158,205 million. The impact of this significant debt increase can be seen in the company's interest expenses, which have also risen. Interest expenses increased by a notable 13% from RMB 2163 at Dec 31, 2024 to RMB 2445 at Dec 31, 2025. This increase is consistent with the overall trend of rising debt levels, indicating that the company's financial obligations are becoming more burdensome. The data suggests that both the company's debt level and interest expenses have undergone significant changes over the past year. The substantial rise in debt levels has led to a corresponding increase in interest expenses, highlighting the need for the company to reassess its financial management strategies to mitigate these risks. Management is optimistic about the company's outlook, citing its leadership position in ophthalmology in China and comprehensive product portfolio. They are focused on expanding into cutting-edge technologies and improving operational efficiency. The company expects significant growth in commercial batch production, including localization of Yaoshiying products and transitioning beyond scale expansion. Innovation, collaboration, and market education are key drivers for the new growth engine, while diversifying revenue sources through contract development and manufacturing organization. CDMO business is also a priority. Multiple near-term and mid-to-long-term catalysts in the R&D pipeline are anticipated, further solidifying the company's outlook. Overall, management is confident in the company's ability to drive growth and expansion in the ophthalmic industry. The company's financial activities have been transparent and well documented. One notable aspect is its dividend payment history, which indicates that the company has indeed paid dividends to its shareholders. This suggests a commitment to returning value to investors through regular distributions. On the other hand, the company has not engaged in share buybacks. Despite having the opportunity to repurchase shares, it has chosen not to do so. This decision may be driven by various factors, including a focus on investing in growth initiatives or maintaining a strong cash position. There are concerns about inventory buildup in the company's operations. The issue is evident from various indicators, including a yes mention on page 110 regarding inventory buildup. This concern is further supported by financial data showing an increase in the cost of inventory recognized as an expense, with a notable jump of RM 149,478 between 2024 and 2025. Moreover, the company has also seen a significant write-down of inventories during this period. Additionally, the inventory levels have increased across different categories, with raw materials and consumables rising by 12% and finished goods increasing by a substantial 50.3%. These statistics suggest that the company is facing challenges in managing its inventory effectively, which could potentially disrupt supply chains if not addressed promptly. That concludes the financial summary for OCUMENSION Therapeutics. Feel free to comment below, and I will be happy to answer them when possible.